Hi there, I'm Mark Wilson. I am here to go over one of the courses, an abbreviated version of one of the courses in the Essentials of Financial Literacy that the Financial Planners Association of Orange County's Pro Bono Committee are putting together and making available. My name is Mark Wilson. I'm an accredited pension administrator and a certified financial planner. What's the financial literacy program? Well, we really want people to get some knowledge and skills needed to help them make informed financial decisions, use their resources effectively, and to confidently take action and achieve their goals. And so we put together this series. It's an ongoing teaching series that we do quarterly, but we've also broken them out into some YouTube, which are abbreviated sections of the same topics. Today, we're talking about home ownership and what this is not. And again, the fine print is here. This is not specific individual advice. This is not tax advice. This is not legal advice. And I'm not going to be providing any specific investment recommendations for you. So again, take your time to read through the fine print here. The way we see it is there's actually 5 steps to buying a home. And the steps, typically, people jump right into the middle of the process. They jump right into shopping for a home before they do anything else. And that's like going to the Tesla or the Mercedes dealership when you're 21 years old and starting to test drive cars. You may be doing something that doesn't meet your financial, they're able to afford financially. So what we recommend is this, in the step process is actually in step 1 to get ready. Step 2, figuring out your finances. These 2 steps will get you ahead of the game so you know you're looking at the right houses, not looking at one too small for your budget, and also not looking at one too grand for your budget. So we wait all the way till step 3 before you actually are shopping for the home, which again, most people just jump on to Zillow or any of these websites and start shopping. Again, that's putting the cart before the horse. We'll talk very little about the actual buying your home process. This is more about getting ready to buy a home. And we'll talk just briefly about the things to think about when you're maintaining a home. When you're getting ready to purchase a house, there's really 2 factors that determine how much you're able to borrow. The first factor is your credit score, your credit worthiness. So out there, the FICO scores are the main score that's being used to do this. FICO stands for not what you expect, but it's actually the Fair Isaac Company, which is the group that put together the original FICO scores. And behind the scenes, these credit reporting agencies, there's a handful of them, are watching every single month. They get a report of how you're doing with your credit. Are you making your bill payments on time? Are you making your credit card payments on time? You're paying your car on time. You're paying your student loans on time. You're paying your mortgage if you have one on time. And those are one of the factors that go into your FICO score. And again, this basically is how good of a risk are you from a bank's point of view that are you going to repay these loans? So folks that don't have good credit history, a bankruptcy, or folks that have really good payment history where they're making the payments on time, those folks tend to be at the higher end of the FICO scores, and folks that have had struggled, especially more recently, will be on the lower ends of the score. These scores help determine whether they're going to give you a loan, the lenders, and how expensive the loan is from a cost and an interest rate standpoint. The very first thing to see what the credit reporting agencies have on you, what information they have on you, is to go to the annualcreditreport.com website. You're able to get a free credit report from the 3 most major credit reporting agencies. You can go on, you answer some information to prove who you are, and they'll show you everything they know about you on a credit side. And it'll show you that you have this credit card, it was open on this date, here's the balance, here's the maximum, here's your payment history, here's how many payments you might have been late on or missed. And on every single thing. This is a great, even if you're not shopping for a mortgage, this is a great thing to do at least once a year to see, first of all, to make sure the information is accurate, but also to make sure that the information, if it isn't accurate, you can actually dispute it. So look through and look for cards that no longer are tied to you, that never were tied to you. And if they were never tied to you, then you can go in and you can dispute the information, or if you did make that payment, you can dispute that as well if they're showing otherwise. Very good thing to go through, and also to go through a past to clean up your credit. If you have that store card that you bought that you set up when you were 19 years old and you got a 10% discount, you get an opportunity to go ahead and see that, but maybe you'll want to contact those and get those closed out. The things that are the most important factor on the credit scores are your payment history, how long you have a payment history, but there's other factors such as your mix of credit and how much you've utilized of your credit. If you have credit cards with $10,000 balance and you use $9,900, that's a higher risk and lower credit score than someone that has $10,000 and has only borrowed $100 against that. The other big component is your how much you're borrowing and what are called different ratios that the banks look at. To talk about the ratios, we first have to talk about the things that go into those calculations. And the main thing that goes in are what are called the PD, principal, interest, taxes, and insurance. But there's also two other areas as well. You might be subject to what's called a PMI, principal mortgage insurance, as well as you might have homeowners association on your condo, townhome, or even a single family residence. All of these things get lumped in and added together to help determine whether whether a bank thinks you can afford the house. Principal is when you have a mortgage payment, each month you're paying down a little bit of principal and a lot of interest every month, especially early on. So that's lumped together in one payment. You don't typically make the payment and make a principal payment and a separate interest payment. There's also taxes and insurance. Taxes are your property taxes. Certainly you have to pay each year. The payments are required twice a year, but you can set up what's called an escrow payment, where these are automatically gathered from you every month. And then when the taxes are due, they send them directly to the tax. So you don't have to save that separately in these big buckets at a time. And then your homeowner's insurance typically can be lumped in an escrow or could be just directly paid to the insurance company. If you borrow typically under 20%, if your down payment is under 20%, typically the lenders are going to require principal mortgage insurance, and that's just to protect them from you defaulting on the loan. PMI can also be, in some cases, a 10% number as well. But just be aware if you're making a very small down payment, and in the bank's minds under 20%, you might have this additional insurance that you have to pay. And then again, depending on where you are, living, you might have homeowners association fees as well. In this example, the client or the person is buying a $500,000 residence. They're putting down a 75% down. That's less than 20% down payment, and that leaves them a mortgage of $425,000. They were able to qualify for a 30-year loan at 3%. How does that break down in terms of total payments? Well, $1,792 is the principal and interest on that loan. $417 is the taxes, monthly taxes. $125 in homeowners insurance. $156 because they did not put a full 20% down. They were subject to PMI. They have to pay $156 a month. And then in this case, we're assuming the client had, or the person had, $210 of additional homeowners association. So their total payments is around $2,700. Why are we adding all of these up? Well, it's to determine what we can afford. Two factors here. One is for you to go through your budget and figure out what you can afford. And what you do there is you look at your total net monthly income, what comes to you on your paycheck after all the taxes and any things that you're putting in, maybe your 401k. And then you subtract out your monthly non-housing expenses. Ideally, you have some kind of simple budget, and you're looking at things like food and car expenses, gas, insurance, all of these different expenses. Whatever's left over is available for housing costs. This is a very good thing for you to kind of work through and see how much could you afford without, starving yourself or not paying your car payments. The banks are going to look at things from a very different standpoint. They're going to look at what it's called debt to income ratios. And these debt to income ratios are over a certain amount that banks start to get nervous and in some cases won't loan it to you. So let me give you an example. So we talked before, the previous, all of those numbers added up to $2,700. If your total gross income is $2,800, the bank knows that you can't pay $2,700 in housing expenses. That would be a debt to income ratio, say roughly 90% or 95%, certainly not reasonable. So what they do is they add up all of those housing expenses, the PITI, and maybe the PMA, maybe the homeowners association fees, and they compare that to your gross monthly income. If that number is more than 30%, and we'll see an example of this in a second, if that's more than 30%, the banks start getting nervous about loaning the money to you, meaning 30% of your gross income is going strictly to those 4 or 5 items. If it gets over that amount, then the banks are starting to get skittish. It gets over 40% for this, what's called the front end DTI, then you're very, very unlikely to get any loan at all. Then they add and take your monthly housing expenses and they do this, what's called a back end debt to income ratio. And that they add in all your other monthly debt as well, credit card debt, car debt, student loan debt, and so forth. They add in those extras and they look at that and say they want no more than 50% of your gross income to go to all of your required debt payments. Let's look at an example here. And then just one last point before I move on is it's important that you compare your top numbers to what you think you can afford and the bottom numbers, what the bank thinks you can afford, and they don't necessarily have to match each other. So let's look at the debt to income ratio example. Here we have a family with monthly income of $9,000 a month. So we take that, multiply it by 0.3 or 30%, and that equals $2,700. We also look at their back end ratio, 9,000 times 50%, and that ends up with $4,500. If you remember, between the principal interest, property taxes, homeowners, mortgage, and HOA fees, those in the previous example added up to $2,700. That is 30% of this client's monthly family income, and that's their gross income for pre-tax and so forth. That where this person is in line to be able to afford, the banks will look at them and say, this is a pretty reasonable person to loan money to. If then they add in things like student debt and credit card debt, and they are also under $4,500, the banks will look at this as a lender that's probably pretty darn good. The next step is to really understand the different types of mortgages. And the mortgages has a huge variety, right? All mortgages have the amount that you're borrowing, have different interest rates. Interest rates are based on the risk factors. Low FICO scores might pay a little bit higher. Today, interest rates are very low, but next year, who knows where interest rates will be. There are typically two types of interest rates, either fixed interest rates or adjustable. I personally prefer fixed rates given today's interest rate world. It's hard to imagine things will be substantially less than they are today. So look towards fixed interest rates. There are different terms of loan, whether you're paying for 30 years, 15 years, and there's everything in between. Most people today are getting 30-year, especially for their first mortgage, 30-year mortgages. And then the really important part are the points and fees. Points are upfront fees that are charged, usually to help buy down an interest rate or pay down, reduce your interest rate, where you're paying more upfront, but you're getting a lower interest rate. And then these mortgages have all kinds of fees in them, such as just the typical lender fees to pay your lender, but also different title fees, recording fees, and all kinds of fees. When you are getting your mortgage and you're comparing them, and not all different mortgage folks have the same fees and points, so make sure you're comparing apples to apples. If one has a lower rate but much higher fees and points, then that may not be the better loan for you. And then once you get your mortgage, you have what's called an amortization schedule. That's simply where you can see that if you make these payments and it pays off a little bit of this principal, a little bit of this interest every month, eventually when you get to 30 years, you owe nothing to the bank. It's important to shop around for a mortgage. I know people that drive 6 miles to go get cheaper avocados at the grocery store, but they don't actually shop the mortgage. So if you are looking around for mortgages, don't just go to the first person that you ever work with, or you're the person that is referred to you. Go and get a couple quotes. There's online services, there's credit unions, there's mortgage brokers who look at a variety, and there's your bank that you're working with. It's good to get a list of the loan estimates from these different options. And they're typically a 3-page form that gives you the details. I wouldn't go get 62 of them, but if you get a handful of them, compare them, you really can compare apples to apples, make sure you're getting a good deal. Again, this is going to save you way more than those avocados I mentioned. So it could save you tens of thousands of dollars if you're looking at the fine print and getting the best loan for you. And if you don't understand, ask questions. Your lender should be able to answer, what's this? What's this? What's this? That's really important, and a really important factor with any loan person that you're working with. I skip over the items as far as the negotiating for the loan and hiring your team to find the house and all of these different items. We skip to step 5, which is something that people forget, is it costs money to own a home. So once you buy the home, you still have the issues of ongoing maintenance. So people that are living with mom and dad or renting, they may forget that there's ongoing cost to owning your home. Some are when you first buy it, you move in and you want to get rid of that wallpaper, that ugly carpeting, you might want to paint, but you also might need to put something into the house, like buy that new kitchen table and so forth. But the one area that I think a lot of people miss is the ongoing cost of owning a home. Especially renters may not remember that there's, they're not paying for that hot water heater or the landscaping or any of those. The other thing is that the ongoing costs can, on average, people expect around 1% of the house value over to be in ongoing home ownership costs. It doesn't happen every year, but they can be, things typically add up, and then you have these big items. So for example, you might not, on a $500,000 house, you may not be paying $5,000 a year in ongoing ownership costs, but every 5 years, you might have a big expense. Could be a problem, could be a new roof, something like that. So just be aware that these are part of that, and that needs to be in your math when you're figuring out what you can afford. If you are in trouble with your loan and you're getting ahead of yourself and it becomes a struggle, don't wait till it's too late. Ask for help early. The earlier you ask for help, the easier it is to fix the problem. That's true of most things, of course. And here's some resources for you. You can talk to your lender. They're actually more reasonable than you expect, and working with them, they might be able to work with you. But there's also the Home Preservation Hotline, some HUD-approved housing agencies where the link is here, as well as state and financing agencies. Those are areas where if you are struggling, go ask for help and make sure you don't get too far behind. This is obviously a whirlwind tour of home ownership. We do these classes. I'm usually teaching this for about 30 minutes, but we get a lot of really good questions along the way. So pay attention on the FPAOCprobono.org website, FPA, Financial Planners Association, OC of Orange County, our pro bono organization.org website has 2 things on there. One is you'll see when these are being taught, so you can see the next session for the different 4 course series, but also you can book time with a your own personal financial session with a CFP professional. The FPAOC Pro Bono Committee has about 20 different folks that are donating up to 45 minutes to talk to you, not just about your home ownership questions, but also about any question that you have as far as financial type questions. And go ahead and schedule that time and do that. It's free. There's no obligation. There's no sales pitch or anything like that. So please take advantage of that. We look forward to working with you.